Hello everyone, welcome back to the second part of the video. Today we are solving 2022 May-June paper 12 and this is the part 2, so we'll start from question number 11. The question number 11 says, on what basis does a trading business produce an income statement? The bases are, number 1, cash received and paid out by the business in the year. So this is a cash basis. So we record all the cash received and all cash paid. Number 2, income earned less costs incurred by the business during the year. So here we are just including income and all the expenses in the year as per the accrual basis. And third one is revenue received less any cash paid out by the business during the year. So here we have received the revenue, but we are also considering all the cash paid. So the correct option in your answer is option 2. Okay. And this is your answer is D. Question number 12. A business provides the following information: revenue, opening inventory, closing inventory, purchases. Goods are sold at cost plus 25%. So this is cost plus 25 means this is markup. The owner has taken goods for own use but has not recorded this as drawings. What is the value of goods taken for own use? So we need to find out what is the amount of drawings. So we know that how to find out gross profit, which is revenue minus cost of sales. And here 25% of the cost of sales is your gross profit. Okay. The problem in this case is, if I show you this format, we have a revenue, cost of sales is opening inventory, purchase, drawings. Okay, drawings and closing inventory. Now, we don't know what is our drawings. We need to find out this figure. But this is very simple. We know our revenue is 140,000. Now, gross profit is 25% of the cost of sales figure that we get out here. Okay, let this figure be X. Now 25% of this, that means it is 125% of revenue. Okay, so our cost of sales or the gross profit is revenue into 25% divided by 125%. So our gross profit is 28,000. That means our revenue is, the cost of sales is revenue minus gross profit, which is my 112,000. So if I calculate to verify this one, if I calculate 25% of cost of sales, which is into 25%, then I should get 28,000. Okay, correct? Yeah. So now I know what is my cost of sales. My closing inventory is 24,500 as per the question. Okay, drawings I don't know, let that be Y. And opening inventory is 22,000 and the purchases is 120,000. Okay. So I need to solve this, and this is very easy. 22,000 plus 120,000, 144,000. In that, if I subtract 24,000, then I'll get equals to this plus this minus this, and it's coming only 117,500. So that means I need to subtract more. Okay, so how much more do I subtract? Is this figure minus this figure, and is 5,500. So that means if there's a drawings of 5,500, then I'll get cost of sales as 112,000. Okay, let me show you here. This minus this, yeah, 112,000. So my drawings is 5,500. Where's the answer? 5,500. Your correct option is A, 5,500. Now the next question is question number 13. A business owner does not maintain a full set of accounting records. All at the end of the financial year, the following information is available. So trade payable, opening balance 22,500, closing balance 27,400, return outward 1,000, and payment to trade payable 110,600. There were no cash purchases. The opening and the closing inventory has remained at the same amount. What was the amount of cost of sales? So we need to find out what is the amount of cost of sales. For this, we need to prepare trade payable ledger account. So let's say this is our trade payable ledger account. Opening balance BD is given to us 22,500. The closing balance CD is 27,400. Okay. So opening balance and the closing balance is calculated. Then there is a return of 1,000 and the payment of 110,600. So there is a return 1,000 and payment maybe from the bank 110,600. So the total on the debit side is 139,000. So we need 139,000 minus 22,500, which is 116,000, which is my purchase. Okay. Now when we prepare cost of sales, we have opening inventory and then we have purchases, then we have less return, and then we have less closing stock. Closing inventory. Okay, so the opening inventory and the closing inventory remain same. So assume that opening inventory is 10,000 and the closing inventory is also 10,000. The purchase we just calculated to 116,500. And there's a return of 1,000. So 1,000 was returned. So the cost of sales is auto sum of this, which is 115,500. So your correct answer is 115,500, which is C. Okay, next question is question number 14. The provision for the Partnership Act applied if partners do not draw a partnership agreement. Which statement is true as a provision of the Partnership Act? So as per the Partnership Act 1890, there will be no interest on drawings, no interest on capital. Partner will not be given any salary. Profit and losses are to be shared equally. They should contribute equal amount of capital in the business. And if there is a partner's loan, then we should provide them 5% interest on that. So the option says interest on drawings is to be charged 5%. So this is incorrect because we don't charge any interest on drawings. Interest on loan from partner are to be paid 8% a year. So interest on loan from partner should be paid 5% per annum. And number C is partners are not entitled to salaries. This is true, partners are not entitled to salaries. And last one is profit are to be shared in the ratio of fixed capital. No, this is also not true, because profit or losses are to be shared equally. So your correct option is option number C. Okay, let's start with the new question. Question number 15. Dow and Noor are in partnership, sharing profit and losses equally. They admitted Zin and now shares profit and losses in the ratio Dow Noor Zin 2:1. On admission of Jin, intangible assets were reduced in value by 20,000 and goodwill was valued at 60,000 but was not retained in the books of account. What was the net decrease in Noor's capital account? So in this question, we can see that there is the reduction in the value of non-current assets. So there is a loss on revaluation, and there is a value of goodwill which is 60,000. So in partnership, we have learned if there's a loss, then we should give it to the partners in their old profit sharing ratio. So this is loss in old profit sharing ratio. So loss is 20,000, so equally, which is 10,000 for each of the partners. And goodwill will be shared in old profit sharing ratio on the credit side and in new profit sharing ratio on the debit side. So goodwill is in new old profit sharing ratio, which is 60,000 divided by 2 is 30,000 each, and then not get anything, and the goodwill will be divided again here in the new profit sharing ratio, which is 2:2:1. So 60,000 divided by 5 into 2, and this is coming 24,000. So this is also 24,000 here, and this one is 12,000. So that means in Noor's, we can see that his debit side is 24,000 and his credit side is 30,000. So as per this question, how much Noor's capital is decreasing? So it is 34,000 minus 30,000, and it is 4,000. So Noor is losing 4,000. Noor is losing 4,000 in this admission of new partner, which is option A is your right answer. Okay, the next question is question number 16. The following information is available for a partnership. Profit for the year before interest 15,000, interest on partner's loan to the firm 1,000, interest on capital 2,000, and drawings amount is 10,000. Which profit figure should be apportioned between the partners? So it means that how much is the profit for the year we should have, so that we can divide that between the partners. Okay, it is the figure that we transfer to profit and loss appropriation account from profit and loss statement. So in this case, profit before interest and tax is 15,000, and we have an interest of partner's loan which needs to be subtracted because the finance cost 1,000. So 15,000 minus 1,000 is 14,000 is the profit for the year, which we transfer to profit and loss appropriation account. So the correct option is 14,000 C. Okay, the next question, question number 17. Which items should not be recorded in the statement of changes in equity? Option A, bonus issue of ordinary share. B, dividends paid on ordinary shares. C, profit from operations for the year. And D, transfer to general reserve. So in statement of change in equity, we definitely record bonus issue of ordinary share. We do record this one, and dividend paid on ordinary share also be recorded. only the proposed dividend will not be recorded, but interim dividend that we pay during the year should be recorded. And transfer to general reserve will be recorded. It is from the retained earning to general reserve, that is also recorded. But we do not record profit from operations for the year, because we record profit for the year and not profit from operation. Profit from operation is before subtracting interest and tax, so that's why we do not record this. So your correct option is option C. That is your right answer. Next question, question number 18. The following information has been extracted from the statement of financial position of limited company. 6% debenture 26/28 20,000. 400,000 ordinary share of $1 each, 400,000. 5 years bank loan 200,000. Share premium account 50,000 and retained earning 75. What is the value of total equity? So equity is the total amount invested by the owner in the business. So here we know that the ordinary share is owner investment, so this is the part of equity. Share premium is also part of equity. It is the excess amount that we charge during the issue of shares. And retained earning is the total amount of money or profit that we kept back in the business. So these three consist your equity, 400 plus 50 plus 75, that gives 525. So this is your right answer. Okay, the next question, question number 19. On 1st January, X Limited had shared capital of 100,000 ordinary share, which had been issued at their par value of $1 each. There were no share premium account. On 1st March, a bonus issue of 1 new ordinary share for every 5 ordinary shares held was made from retained earning. On 1st June, the company made an right issue of 1 new ordinary share for every 4 ordinary share held at a price of 1.50 each. All the right shares were taken up. How much was recorded in share premium account? So we can see here that we had 100,000 shares before, and then we make a bonus issue. The bonus issue is 1 share for every 5 already held, and then on 1st June we are giving right issue, and this time 1 right issue for every 4 ordinary share, and the price of right issue is 1.50. So 0.50 is our premium amount. So let's do the calculations here. 100,000 ordinary shares, and then we are giving bonus for 1 for every 4 already held. So into 1 for 4 or 5, I think 5. Bonus for every 5 already held, so divided by 5, and we are giving 20,000 shares, bonus shares. The total shares that we have is 120,000 now. Then we have the right share. Right shares is equals to 1 share for every 4 already held. Okay, so 30,000 right shares. Where is the amount? It says 1 new ordinary share for every 4 held at a price of 1.50. We just need to calculate the share premium amount, and the premium amount is 0.50. So we'll just multiply this with 0.50, and the total amount is 30,000 into 0.50. So 15,000 is the amount of the premium. So this is your answer, 15,000. Next question, question number 20. The following information is available for a business. Sales revenue 500,000, purchases 365, gross margin markup, inventory at start of the period. So question is, what was the value of closing inventory? So we need to find out the closing inventory. So sales is given, purchase is given, gross margin is given, and then markup is given. So inventory needs to be calculated. So if you have sales given which is 500,000, then your gross profit, your GP would be calculated in gross profit margin. Okay, gross profit margin is 25% out here. So we will calculate what is our 25% of this. So your gross profit is 125,000. Now if the gross profit is 125,000, then the cost of sales is sales minus gross profit, which is 375,000. Now how do we calculate the cost of sales? Cost of sales is opening inventory plus purchases minus closing inventory. In the question, we know how much is our purchase, 365,000. 365,000. And we also know the inventory at the start of the period, opening inventory 20,000. So opening inventory is 20,000. And in this figure we need to subtract closing inventory. So how much should I be subtracting from here so that it would be 375,000, which is minus 10,000. So if I subtract 10,000, then my cost of sales would be 375,000. So my answer to this question is 10,000, which is option A. With this, we come to the end of our part 2 video. I'll solve the next 10 question in our part 3. So till then, stay tuned and hit and like.